Market structures are important because just as the human being has a structure, the human being has the head, the hands, the body, and the legs, and the anatomy, which is the skeletal framework that makes up the body. That is just how price also has its structure. There are three structures in price. There are three market structures in price. That is the bullish market structure, the bearish market structure, and the ranging market structure. The bullish market structure, in this process, the market is in a buying order flow. The market keeps making series of higher highs and lower highs. For instance, here, this is a bullish market structure. You can see the market making series of higher highs, lower highs, and higher highs. Lower highs and higher highs. While a bearish market structure, the market does the opposite. The market makes a series of lower lows and what? And higher lows. Lower lows and higher lows. Lower lows and higher lows. Identifying this makes it possible for a trader to identify a trend and have a perception of the direction of the market and the market sentiment at a particular period in time. While a ranging market structure, we see price pushing from one support line to another. For instance, this is a ranging market structure. You see price pushing from one support to another resistance. As you can see here, you see price pushing from one support to another, as you can see here. So now in this lesson, we are going to learn how to identify market structure on the chart, and we are going to have examples. Now you should keep in mind that there are reasons why the market ranges, and there are also reasons why the market moves in a trend-like manner. The market ranges to accumulate orders, because you cannot just expect the market to be trending all the time. The market needs to range to contract and accumulate orders, buy orders and sell orders alike, then move in the intended direction. And when the market is trending, if the market gets to a limit, then it has to what? It has to accumulate again, range, and also trend in another direction. As you can see here on Euro USD, right here before us, we have a bullish market structure. We have a bullish cycle. Here is the lowest point, which we can term as the high. Here we have a higher high. Here we have what? We have a lower high. And here we have a higher high. At every point when you see this lower high, you can see that the market contracts and goes down. This is a correction. Once the market makes a lower high, it prints out a bullish pattern that corrects it back to the trend to continue the bullish cycle. You can see a correction back down, and what can you see here? You can see a pattern is printed out, then the cycle continues. You can see a correction down here, then you can see what the pattern continues. So now you should be able to identify a trend and also the correction in the trend. And as you know, in the forex market, time is fractal. So here we are looking at the bigger picture, which is the 4-hour. I prefer to use the 4-hour because institutional traders use this time frame a lot. They don't just sit down looking at the 1 hour or the 15 minutes. They don't have time to do that. They look at the overall bigger picture and scale in their positions on the bigger picture. On this other hand, we can see a bearish cycle. We can see a lower low, a higher low, a lower low, a higher low. We can see that at every correction, a bullish candlestick pattern is printed out to continue in the direction. So for you to confirm a market structure, you need to see two consecutive lower lows. For instance, here, before we see this push up, this is the lowest point. Let me mark it. This is the lowest point. And you can see price successfully breaks it here. So we can confirm here as the lower low. And after that, you can see that price contracts and price breaks this lowest point before it contracts, and this is another lower low. So now we can confirm this as a bearish market structure. Likewise, if it is a bullish market structure, to confirm it, you have to see two higher highs. You have to see two higher highs. If two higher highs are not printed out, you cannot conclude that it is a bullish market structure. For instance, this is the lowest point, and before this push down, you have this contraction phase. So if it is broken, you have our first high. Here we have our first higher high. Then market draws a correction. So before the correction, this is the highest point here. Let me draw the line there. Then we can see price breaking it again. So now we can confirm that this is a bullish market structure since we have two higher highs printed out. Then thereafter, what do you have? You have a correction to this lowest point, and it's broken again. And you can see now we have three higher highs, and the market continues to push up. And the market continues to push up. So that is how you identify a bullish market structure. And to identify a ranging market structure, as I've said earlier, you see price bouncing from one support line to another resistance, bouncing off from the resistance back to the support. Let us take an example on that. Let me clean out this line. Let me clean out this line and go and look for a ranging market structure and show you how it plays out. Within a bullish cycle, we can also have a ranging market within. For instance, right here, before the bullish cycle continues, you can see price jumping from the support to the resistance, bouncing off. This is a range. You can see right here. It is a contraction phase. So there are ways you trade a ranging market and there are ways you trade a trending market. However, I hope we have learned how to identify market structures, which is important, and we can practice on our own and do well to identify more trends on our own. Let us take some more examples. You have a range here on USD card. You can see price bouncing from one support to another resistance. This is a ranging market structure. There is no clear direction. You can see price bouncing from one support to another resistance, bouncing from one support to another resistance, bouncing from one support to another resistance. Price breaks up, then gets back into the range. Here we have a bullish market structure. You can see the lowest point here, and we have two. This is the first higher high. We have a lower high, and we have another higher high broken, so we can confirm that this is a bullish cycle, and you can see that price buys up, price continues to push up. Likewise, if it is a bearish cycle, we need to confirm two lower lows to conclude that price is going to continue pushing down. And here we can see the first lower low, the break. You can see the higher low, and we can see a lower low, and later this lower low is broken again. You can see this lower low has been broken. So after seeing the two lower lows there, we can confirm that it is a bearish market structure on USD CAD. On gold here, we can see a bullish market structure. To confirm that, we need to see two higher highs. As price breaks this line, you can see this is the first higher high. Then you can see another higher high right here. And you can expect price. You can see that the price continue to push up as the cycle on gold is still bullish. So once you learn how to identify market structure, it will be easier to have a perception into the market sentiment and where price is likely to head to. I hope you have learned from this. Please like, share, follow, and subscribe. Turn on your notifications so you can get more content on this.